Welcome back to my channel. This is going to be a crash accounting course. By the end of the video, you should have a solid understanding of accounting. Let's get started. You can define accounting as the process of recording and reporting your financial information. There are rules and vocabulary the world uses to discuss the financial accounting world. Financial information is reported using specific documents known as the financial statements. There are two major financial statements you must know. The first report is the Statement of Operations, better known as the income statement. It reports the revenue earned and expenses incurred during a time period. The report starts by listing and totaling all your revenue or sources of income, followed by all the expenses incurred. The last line reports your net income or loss, which subtracts all the expenses from your total revenue and shows your profits or losses. Remember, the income statement reports the revenue for a period of time. So, whether it's a monthly income statement or an annual one, the period covered would be specified in the title. Also, note that revenue is the money generated by running your regular business operations, and the expenses are costs you incurred when running your business and generating the income for that period. Moving on to the second key financial report, the balance sheet, which professionally we call the statement of financial position. Keyword being position because it reports a specific moment in time, and the balance is from the balancing process that occurs. The balance sheet basically stems from the famous accounting equation assets equal to liabilities plus owner's equity. This means the total of everything you own is going to balance to the value of your liabilities plus your owner's equity, which is the equity you hold in the organization. Let's consider the simplified balance sheet. In a balance sheet, all your assets will be listed and totaled. Then all the liabilities will be listed and totaled, followed by the owner's equity. Then you would have a grand total that adds the liabilities with the owner's equity, and that grand total should balance to the total of the assets, hence reflecting the accounting equation. And I've highlighted those two line items in gray. So, as you saw, the balance sheet follows the accounting equation of assets equal liabilities plus owner's equity. As a side note, I want to rephrase the equation in case it still doesn't make sense for some people. We can rearrange the equation to owner's equity is equal to assets minus liabilities, which makes sense because your total equity or ownership of the organization can be calculated by taking all the assets owned less all the liabilities owed to others. So let's have a quick look at some of the accounts reported on the balance sheet. So, in general and simplified terms, here's the quick definition of the major components. For the assets, it can include properties and anything held of value, from your cash, your bank accounts, accounts receivable, inventory, furniture, cars, even intellectual property, etc. It basically lists all your economic resources that normally will be used in the future to help produce more value to the company. Often, assets are further classified into current and long term assets. Current assets are the short term and more liquid assets, such as your cash and cash equivalents. Long term assets are more of the fixed assets, like your land and buildings. For liabilities, we can define them as financial and economic obligations owed to others. They include all forms of debt and deferred revenue. Be sure to check out my previous video dedicated to deferred revenue for details. To recap what we discussed so far, we talked about the income statement and how it houses revenue and expense accounts. We talked about the balance sheet and how it houses the accounts falling under assets, liabilities, and owner's equity. So you should now have an understanding of the financial statements, or at least the two key ones we discussed here today, and the accounts included in each. Now let's talk debits and credits. Every accounting entry has a debit and a credit side. When you record a transaction, you will be debiting one or more accounts and crediting others. Every entry must balance, meaning total debits must equal total credits. Depending on the type of account, it will either increase or decrease when debited, and same goes for when they are credited. For example, cash increases on the debit side and decreases on the credit side, while accounts payable, for example, increases on the credit side and decreases on the debit side. So, how do you know? Let's find out. And once you understand the concept, it becomes very simple and almost second nature. The accounts that increase on the debit side and decrease on the credit side are all asset accounts and expense accounts. So, anytime you debit an asset or expense account, you are increasing its value. And to decrease the value, you would credit the accounts. The accounts that decrease on the debit side and increase on the credit side include liabilities, owner's equity, and all revenue accounts. Therefore, understanding the type of account you are working with and being able to classify it as an asset, a liability, revenue, or expense account is crucial in knowing whether you should be debiting or crediting the account in a given transaction. Now let's look at the actual recording of the transactions. When a debit is made to an account, it is entered on the left side, and a credit is entered on the right side. For example, this transaction demonstrates a debit to the cash account for $20 and a credit to the sales account for $20. By debiting cash for $20, we are increasing the value of the cash account because cash is an asset and assets increase on the debit side. On the other hand, we have sales, which is a revenue account, and by crediting the account, we are increasing its value. Let's look at another example. You decide to take out a $1,000 loan. How would you record that transaction? Well, the $1,000 gets deposited in your bank account and it's basically now cash. Cash is an asset account and you now have more cash, so you need to increase your cash balance. So that would mean you would have to debit your cash account for $1,000. On the other side of the equation, you've now increased your liabilities because you've took out a loan. So we can credit loans payable, which is a liability account, for $1,000. And by crediting the liability account, we are increasing it. So then now we have our debit and credit side, and the equation is balanced. Let's look at another example. You bought a car worth $10,000. You paid $5,000 using cash on hand and financed the remaining $5,000. How would your entry look like? Well, we need to record the new car, and we know that its value is $10,000, and a car is an asset. So we're going to debit the car account for $10,000. We paid half with cash, so we know cash has to be decreased by $5,000. Cash is an asset account, and we know assets decrease on the credit side. So we're going to write down cash and credit it for $5,000. The remaining was financed, so that means now we have a car loan for $5,000, and that is a liability. Liabilities increase on the credit side, so we're also going to credit the car loan for $5,000. Now, looking at the entry, you can see we have total debits of $10,000 and total credits of $10,000 because we're adding the $5,000 from the cash and the $5,000 from the car loan, both of which are credits in this transaction. And we have our balanced entry. I hope you found this video helpful. Don't forget to like, share, and subscribe.